Welcome, everyone. We're glad you could join us for today's Thought-Centered webcast. These webcasts, are a series of live interactive events featuring EY's thought leaders. We have a fast-paced session for you today, covering many fresh off the presses federal and state developments to note for 2019. I'm Christy Lowry, the National Director of the Employment Tax Advisory Services here at Ernst & Young, and I'm happy to be today's moderator. Today's program will talk about federal updates from Janelle Razuk, who's a Senior Manager in our Employment Tax practice.
Thank you, Christy. I'm happy to be here today.
And then after Janelle, we will hear about 2020 Form W-4 employer considerations, and later on in the webcast, payroll year-end checklist items from Debbie Salam.
Very happy to be here. Thanks, Christy.
And after Debbie, we will be hearing from Tom DiLorenzo on 2020 Form W-4 employee considerations.
Thanks, Christy. Great to be here today.
We're glad to have you today, Tom. And then after Tom, we'll be hearing about state-paid family and medical leave insurance, and later on about taxability from Nico Ehrhoff.
Thanks, Christy. Great to be here.
And then lastly, later in the webcast, we'll hear from Peter Berard on other state and local developments.
Good afternoon, Christy. Great to be back. Thank you.
With that, I'm excited to get started. So, Janelle, why don't you go ahead and take us away?
Super. Good afternoon, everyone. When we start talking about the changes for the next year, I think what most people are interested in are the new employment tax rates and limits. Of course, the Social Security wage base is going to increase this year. It's increasing $4,800 up to $137,700. One thing I've noticed over the last few years is when it increases, it seems like the increase is increasing each year and the bump goes up a little bit more than the prior year. The salary reduction for a qualified retirement plan, such as a 401k, is also increasing by $500, so the new limit in 2020 is $19,500. Also increasing $500 is the catch-up contribution for your employees that are 50 years or older. We've got increases to the qualified parking and commuter highway, vehicle, and transit passes, increasing $5 up to $270. The Health Flexible Spending Account is increasing $50, so the max in 2020 is $2,750. What's not yet announced is the business cents per mile. It's currently 58 cents per mile, and the new rate has not yet been announced, and we expect that to come out soon. The only amount that hasn't increased on our page today is the federal unemployment insurance wage base, which is holding steady at $7,000. Next, we'll talk about health savings accounts, the contribution amounts and limits, as well as the out-of-pocket limits and the high deductible plan amounts are all increasing this year between $50 and $300. I think the thing that's most important when we talk about health saving accounts, and one that we consult with quite often with our clients, is to remember that both the annual employer contributions plus the employee pre-tax contributions must be reported on the employee's Form W-2 in Box 12 using code W. While Box 12 is an information reporting field, errors in that field do create tax return filing issues for the employees. So it's important to make sure that that gets reported properly. It's also important to remember that individuals enrolled in Medicare are not eligible to participate in a health savings account. So next we'll visit about the reporting of moving expenses. I know you're all aware that due to the Tax Cuts and Jobs Act, that the exclusion from wages for employer-paid moving expenses has been suspended for the period January 1, 2018 through December 31st, 2025, which means that any employer-paid moving and related expenses will be wage income to employees. However, in Notice 2018, the IRS announced that any moving expense that was incurred in 2017 but perhaps wasn't paid or reimbursed until 2018 or later years, that the rules prior to the enactment of the Act would apply and the employer could exempt that amount from an employee's wages. And with that change, there would be no Box 12 Code P reporting for that amount. We get that question quite often as well. The thing that's really important here, and even though that this change has occurred a while back and you're wondering why maybe we're bringing this up, is that not all states have adopted this federal change. So for instance, New York does not conform to this change. They still allow a deduction. However, the Box 16 on the W-2 reports the same amount reported for Box 1. And so the employee has to then take a deduction on their personal return. So it's important to know that not all states have conformed to the federal. Another change for 2020 is that the W-2 verification code pilot program was discontinued. The IRS felt that with the new W-2 deadline being moved up to January 31st, that is helping to prevent tax fraud and that this W-2 verification code is no longer needed. You may recall that this verification code, it's a 16-digit number, and it's 4 groups of 4 alphanumeric characters, and it was reported in Box 9 on the copy B and C of the W-2 form. And if an employee had that number on their form, they were required to submit the Form W-2 when they filed their Form 1040 electronically. But that is now going away. Another change that's been in the works for quite some time is the truncated Social Security number being reported on the Form W-2. The IRS issued final regulations recently that do allow employers the option of truncating an employee's Social Security number on their copy of Forms W-2 and the corrected Form W-2 for any returns and statements required to be filed after December 31st, 2020. There is an exception to the truncation allowance, and that is for statements that are required to be provided to employers by insurance companies detailing third-party sick payments for the prior year. So this sounds all well and good, and it's wonderful from a kind of a taxpayer privacy standpoint. Unfortunately, many states and localities still require the full Social Security number on the state and local copies of the Form W-2, and it's still uncertain when and if the states will conform to this revised federal rule. And if they do, which we hope that they will, that would still take some time. And you all may recall it took 7 years for states to conform to the new filing deadline of January 31st. So we don't expect this to happen anytime soon. Another change this year is that with the signature from President Trump of the Taxpayer First Act on July 1st, there are now lower thresholds for mandating electronic filing of information returns, so Forms W-2 and Forms 1099. So currently, if an employer has 250 or more forms, they're required to file those forms electronically. And by the way, that number, 250, is per type of form. So 250 W-2s or 250 1099 miscellaneous, perhaps. With the filing, with the passage of the Taxpayer First Act, this number gets decreased to 100 forms effective for the 2021 calendar year, and then it further decreases to 10 forms after calendar year 2021. So that's a significant change for employers. I will tell you there is a waiver that will be allowed from this electronic filing requirement that will apply to areas without internet access. So for larger employers, this impact will really impact these employers because they're used to being able to file up to 250 forms on a W-2C by paper, and that will decrease over time down to 10 forms. Another new form that's coming out this year is the Form 1099 NEC, which stands for Non-Employee Compensation. I actually chuckle when I hear that it's a new form because for some of us old-timers, this is actually a form that's been out before. The IRS took it away and now they're bringing it back. One of the reasons they're bringing it back is because the IRS changed the reporting deadline for 1099 miss if there's non-employee compensation reported in Box 7. That deadline is January 31st. But for all other amounts reported on the 1099 miss, the reporting requirement is not until March 31st or February 28th if filed on paper. So in order to kind of fix this issue with the differing filing dates, they're bringing back this form. Again, it's out in draft form. We're not quite for sure when we'll receive the final. So stay tuned. Lastly, we have some new overtime rules for salaried exempt employees. Final regulations were issued effective January 1, 2020 that raised the minimum salary required to qualify for this exemption from $455 per week to $684 a week, which is equivalent to $35,568 per year. I might note that this is a smaller jump than was proposed under the Obama administration, but it is still an increase nonetheless. This regulations also increased the amount for highly compensated employees from $100,000 to $107,432 per year. So with these changes, we want to just remind you to don't forget these higher wage levels when you're budgeting for your employment taxes for the year 2020. And I think with that, Christy, we are ready for our first polling question.
That's right, Janelle. Thank you. That was really, really informative. So we have our first polling question, everyone. Which of the following was your greatest employment tax challenge for 2019? As the answers come in, we'll let you know what the responses are. So next we're going to hear from Debbie Flom, some really, really, really timely and exciting stuff on the Form W-4 considerations. So Debbie, are you ready?
I am, and thanks, Christy. And I want to say that it was perfect timing. This morning, about an hour before we were set to get ready to go live here, the IRS issued the final 2020 Form W-4. So if you guys are wondering why our slides were a little bit delayed, popping up on the screen, That's why we did update the deck to show the latest development from this morning. There were just minor changes made to the final 2020 Form W-4, mostly in Part 2 around privacy. But let's talk about what's happening here. So under the Tax Cuts and Jobs Act, as you all remember, effective January 1, 2018 through 2025, personal allowances are no longer allowed, and as well as a number of miscellaneous deductions were taken away. And this necessarily meant that the IRS needed to modify the Form W-4 and the income tax withholding calculations. Congress envisioned that and gave Congress a year to get that done. In 2019, which is when Congress wanted IRS to get it done, a lot of the stuff that we're seeing now was proposed by the IRS, and businesses and software providers basically gave the feedback that there was insufficient time to incorporate those kind of significant changes before the end of the year. So the IRS announced that it would delay it to 2020. So here we are, it's 2020, and now the IRS is basically updating the Form W-4 and the income tax withholding requirements. And the point that I want to make here is the delay was already given. It was delayed from 2019 to 2020. So I have a lot of clients asking me, is the IRS going to give us a grace period after January 1 to incorporate these changes? And the answer is no, because there was already that 1-year grace period. So today the IRS released the final Form W-4 for 2020. It does include many changes compared to prior years, and the most significant is that on the 2020 Form W-4, you won't be seeing any personal allowances anymore. Along with the new 2020 Form W-4, the IRS also created a new publication called Publication 15T. And this publication shows the new withholding tables and the instructions for doing income tax withholding as it relates to the new Form W-4. The second draft that was issued, I believe in August, actually included all of the changes that the IRS intended to make, except for updating the numbers, the inflation adjustments for 2020. So that at least gave employers an ability to do some testing to see if things work using the old 2019 numbers. Publication 15T, the IRS announced today, that publication will be available in mid-December, and I would expect the older Publication 15 will also roll out at about the same time. So middle of November is when we'll have everything. Now, one question that has come in a lot and the IRS addressed in a recent payroll industry call is what about the lock-in letter? And as you know, the lock-in letter basically trumps the Form W-4, okay? So this is somebody who didn't have enough withholding on their tax return, and the IRS wants to decrease whatever they're doing in their W-4. They want it to make sure that they're getting more income tax withheld. Unfortunately, the lock-in letter has not yet been updated to accommodate the new Form W-4, in particular, no personal allowances, okay? The IRS has not really provided a date when they're going to be updating their guidance and revising those processes. So on that, we're just going to have to wait a little bit more time. Okay, so how does the old W-4 and the new W-4 compare? And what I'm going to be doing in the next several minutes is doing that comparison. And why is this important? In order to, the IRS gives you two ways to deal with the change. You can keep all of your old W-4s prior to 2020 in a separate system and then use only one of the tables that the IRS provides in Publication 15T, and then process those payrolls separately, or you can combine all the W-4s and do everything under one system. But in order to do that, you would actually have to translate the information from the old W-4s into the new W-4 format. And that's what we're going to be talking about here briefly for a few minutes. On the old W-4, in the first section, you'd have people claiming single, married but withhold this higher single rate. That is now changed. The language is different. It's single or married filing separately, married filing jointly, or qualifying widows, and then head of household. So if you're translating, in other words, you want to take an old W-4 and put it into the new W-4 system, because remember, you can't require your employee to complete a 2020 Form W-4. Your translation, for instance, if an employee says married but withhold at a higher single rate, you would make that to be single or married filing jointly, because that would be the translation into the new W-4 system. Then we get to the next section where the employee is claiming total number of allowances that you're claiming from the applicable worksheet. And that has been replaced with Step 2 and Step 3. Step 2 is a checkbox to indicate if you have multiple jobs or you're married filing jointly and you have a spouse that works. And then Step 3 is where you can claim the exemption for dependents. So if you have an older W-4 from prior to 2020, you would treat Step 2 and Step 3 as blank. Okay? All right. So what about additional amount, if any, the employee wants withheld from their paycheck? That amount would carry over to the new W-4 template because there is a section in Step 4 where the employee can ask for additional tax they want withheld. So you would move the amount from the 2019 Form W-4 to Step 4 of the new Form W-4 template. Now, in Step 4, there's other additional fields where the employee can enter other income. This would be maybe equity income or investments and stuff where they aren't going to have income tax withheld. They can add that so that they get additional withholding. And then also in Step 4, they can show deductions, which of course would reduce their withholding. So obviously if you don't have a 2020 Form W-4, those sections would be treated as blank. Okay, what about Step 7 from the old W-4? On Step 7, this is where the employee can claim exempt from federal income tax withholding. Unfortunately, on the new W-4, there is no place to claim exempt from withholding. And there were many comments that were given to the IRS about, putting a specific checkbox back for that, and the IRS indicated that it did not intend to do that. So now, if an employee wants to claim exempt from withholding, they're instructed to write exempt on the Form W-4 in the space below Step 4C, and that's how they would have no income tax withheld. So this is still an item that you'll be able to transfer from the old W-4s to the new W-4 template. Now, the IRS also says that an electronic system can add a checkbox for claiming exempt, provided that the checkbox also includes the language from Publication 15T about the conditions around claiming exemption from withholding. Okay, so let's look at a little bit of a procedural guidance from the IRS. First, the IRS does emphasize that for employees who furnished Forms W-4 before 2020 and who do not furnish a new one after 2019, you have to continue to withhold based on the form previously submitted. You are also not permitted to treat an employee as failing to furnish a Form W-4 if they don't give you a 2020 Form W-4. However, if the employee claimed exempt from federal income tax withholding in 2019, then they are going to have to give you a 2020 Form W-4 if they want to claim that exemption again, because remember, if you claim exemption from withholding on the W-4, that W-4 expires, so a new Form W-4 for the year is required. The same withholding tables will be used for the Forms W-4s issued before 2020 and Forms W-4 issued in 2020 and later years. And as I previously mentioned, you can either, take the old W-4s and translate them to the new W-4 format and handle all of your payroll processing in one location, or you can keep your old W-4s separate, apply the standard table to those W-4s, run those checks, and then run the other checks for 2020 and later. I think that's a more complicated way of doing it, but the IRS does give you that option. Okay, and as I mentioned previously, if you do use a single system to process payroll withholding for all of the W-4s, new and old, you are going to have to translate the old W-4s into the new W-4 format. So hopefully you've already done that and you've tested it and you've made sure that the translation process worked properly. Okay, what about the non-resident employees? As you recall, a non-resident alien, there is an amount that has to be added to their wages. This takes into account the fact that they're not eligible for the standard deduction, so a certain amount has to be added back to get their withholding correct. Okay, and so the IRS now has two tables to do that. There's a Table 1, that's for employees who have an older W-4, and then Table 2 is for employees with W-4s from 2020 or later years. So let's look at an example of what we're talking about. Let's say an employee, the last time they gave you a W-4 was in 2018, and they claim married with two allowances, and they don't give you a Form W-4 after January 1 of 2020. You would use only the standard withholding rate schedules table. So in the 2020 tables now, there are two tables. One says standard, and the other one says Form W-2 step due checkbox. So the only time you use the Form W-2 step due checkbox table is if that section of the W-4 was completed. And obviously, the Step 2 checkbox will only appear on a 2020 or later Form W-4. Okay, I want to move on now to talk about the state implications because this is probably the bigger story. I mean, once you get past the hurdle of these significant changes at the federal level, I think this will be the next challenge for employers. And many are already reaching out to us, already asking for research and information. We are doing a perpetual ongoing survey of the states. But there's going to be an issue, and clearly that issue rests where a state is continuing to allow use of the federal Form W-4, but state allowances are still used in the state income tax withholding calculation. That's going to be a problem, right? Because if your employee completes the 2020 Form W-4 and you're not allowed to have any personal allowances on it, but you can have personal allowances at the state level, you could be over withheld for state income tax. So where do we stack up? If you look at our heat map, you'll see we did some pretty detailed research here. If you look at the states, obviously in gray, there's no state income tax, hurrah, we don't have to worry about them. If you look at the states that are in solid yellow, these states do not have a state-specific form, okay? They're using the Form W-4 for calculating state income tax. Utah addressed its issue by passing legislation. So what Utah did to address the problem is to say, well, in Utah, we're not going to allow for standard allowances either. Personal allowances. So using the federal Form W-4 will be fine because there's really no difference in what we're doing. But look at the rest of the yellow states, if you would, the yellow diagonals, and look for all of them that have a reddish star. If they have a reddish star, they have personal allowances in the income tax withholding calculation. So if they only use the federal Form W-4 and there's personal allowances in the income tax withholding calculation, these states really need to move immediately to either create a state form or change their tax law like Utah did. And this has still not happened. So the question is, when is it going to happen? And what are you going to do as we move into January of 2020? So as I said, we are beginning to conduct telephone surveys with these states that are problematic. And for our clients who subscribe, we're reporting to them what's happening. Okay, we have another issue. If you look at the states, the other states that are, I think, in green on this chart, and look for those that have a yellow dot, that means that there is a state form, okay, but they also allow for the federal Form W-4. And if there is a star, it means also that there are state withholding allowances allowed. So in these states where there is a state form and they allow the federal form and there are personal allowances, in these states you want to encourage your employees to fill out a separate state Form W-4 to avoid over-withholding of state income tax, okay? because using the federal form is going to cut off their personal allowances at the state level. So again, you can't make employees do that, but you definitely want to send out a communication. Now, in the other states that have their own state-specific form, we have no issue. So these states have already addressed the problem by creating a state-specific form and basically decoupling from the federal form W-4. And we've had a lot of developments in that area. Idaho, Montana, Oklahoma, Oregon, they all created their own specific forms in 2019. Nebraska is doing one effective in 2020. And then Wisconsin came out and clearly stated in effective, any new employees or anybody making changes, they're no longer going to accept the federal form W-4. So again, we're seeing a very slow progress in addressing the state withholding issue, and you will absolutely have some issues in some states until they get it resolved. And I expect this will be an issue that will be ongoing all of next year. So how have businesses been addressing this challenge? And I'm just going to go through here some leading practices. November through December, you should have already been doing system testing using the draft data of publication 15T and inputting some mock W-4 data using the 2020 fields and testing to make sure that you've done your conversions of your W-4 data properly, that your income tax withholding calculations are working, and then you maybe want to test some state income tax withholding, again using mock data. So a lot of businesses have been through this process just using the sample data from the publications. Sometime in December, you do want to be sure that you are notifying all your employees of the new 2020 Form W-4. A lot of businesses might be considering the help of a third party to help them develop webcasts, videos, an employee portal, giving them information to help explain it because the IRS information may not be enough. And I know Tom's going to be talking about this a little bit more too. And then, of course, now that we have the final Form W-4, when that final publication 15T comes out, you can start collecting some actual employee Form W-4s. You do already have the payroll system tables for 2020. They're final, so you do have that information. So as soon as you start getting a few employee 2020 Forms W-4, you need to do another test again using real data. And that, of course, needs to happen before the end of the year. And then finally, from December to April, you definitely want to be looking at employee support. You want to consider a call center, maybe operated by a third-party tax professional, to respond to Form W-4 questions and so forth. And hopefully you've already thought about all of that and how you're going to approach that in terms of employee support. So that's the big word on the employer considerations. Tom, I know, is now going to be picking up the employee issues. Before we go there, Christy, would you tell us the results of that last polling question?
Sure thing, Debbie. Thank you. That was really informative from an employer standpoint and certainly fresh off the presses. It looks like almost 50% of you, most of you had challenges with preparing for the 2020 Form W-4. And then secondly, tracking compliance with state and local payrolls. So we do have this next polling question. Please be sure to respond. And with that, we will hear from Tom DiLorenzo on the employee considerations of the new 2020 Form W-4.
Thanks, Christy. Having just heard a lot of great information from Debbie from the employer's perspective on the W-4 changes, we're going to take a look at some considerations from the employee side now. Typically, whenever we see changes involving an employee's compensation or benefits, it normally gives rise to many questions. And when you add tax into the mix, it only adds to the level of anxiety that an employee might be experiencing. So over the next few slides, what we'll do is we'll take a look at some of the frequently asked questions an employee may have surrounding their W-4 and these changes. So for some, the changes to the W-4 may not sound like a call to action. After all, the employee has the option of whether or not to update the W-4 using the new form. However, there could be some adverse consequences of not updating the W-4. Namely, they could be paying too much or too little in tax throughout the year. So those that may be on a tight budget, which a lot of us are, they may find themselves in a difficult financial situation at tax filing time if they did not withhold enough in taxes during the year. And this could be further amplified if they haven't met the minimum withholding requirements to meet the safe harbor to avoid any underpayment tax penalties. The good news is the new W-4 should be more intuitive for some, with it no longer being based on choosing the number of allowances to take. And for those that have a simple tax situation, it should be a fairly simple process. In these cases, an employee really can simply complete step 1 of the W-4 and sign their name at the end. In this instance, withholding will be based on the standard deduction tied to their filing status and the tax rates applicable to their wages, without regard to any other income. So next, let's talk about how the updated W-4 will increase the accuracy of federal income tax withholding. The new Form W-4 is designed to increase the accuracy of federal income tax withholding. But for this more precise withholding to occur, they will need to complete additional steps on the form, particularly if their tax situation is not so simple. While step 1 of the form will simply determine their filing status, steps 2 through 4 will delve deeper into their tax situation to help determine their proper withholding. And I know Debbie touched on some of this earlier, but if we look at step 2, for instance, this is going to ask for information regarding a second job they may have. This step also explores whether their spouse has earned income. Such information like this can be quite helpful, as additional sources of income suggest that withholding should potentially be higher. The third step of the form asks about dependents, namely any children under the age of 17, which would allow for them to qualify for the child tax credit. The greater the child tax credit they qualify for, based on the number of qualifying children they have, the lower the tax withholding will likely be. And then step 4, the last step before signing their name, inquires about other income, deductions, and whether they want to request additional tax be withheld. Non-earned income from sources such as investments and IRA distributions will increase the amount of tax that needs to be withheld, so they're going to want to consider that as well. Completing step 4 of the W-4 can save employees from having to make quarterly estimated tax payments, which for many is a daunting and unfamiliar process, so many folks try to avoid that if possible. And for those who itemize their deductions, completing step 4 allows them to indicate the amount of the deductions that they have that will reduce their income, thereby, in turn, reducing their tax withholding. So now let's take a moment and talk about step 2 in a bit more detail, since this will likely be a scenario that comes up quite frequently, particularly for those that are in 2-income homes. So step 2, as you recall, this allows you to account for multiple jobs you may have, or if you have a spouse with income as well. So for those who wish to adjust their withholding in light of other earned income they have, step 2 does require some additional action that the employee is going to have to take. So there are 3 options for them to choose from. Option 1 is going to entail them using the tax withholding estimator that's available on the IRS website. They're going to use the results from this estimator to input onto their W-4. And I know going to the IRS website for many can seem very scary, but the IRS has really done a nice job in creating a very user-friendly tool, in my opinion, that will help determine what they need to input onto the form. When they go to the withholding estimator, at a minimum, they're going to want to have a copy of their and their spouse's, if married, most recent pay stub, so that they can get the most accurate results from the calculator. Option 1 is going to be the most accurate of the 3 options that we're going to talk about for their withholding. Option 2, for those that just choose not to want to use that tax withholding estimator calculator, the W-4 form provides a worksheet to factor in the income from a second job or their spouse's job. Now, whether they use option 1 or option 2, the fact that they have a second source of income, in this case, will not be revealed to the employer if privacy and protecting their privacy is a concern for an employee. Option 3, however, is not only informs the employer of a second job or a second source of income, but it's also going to be the least accurate of the 3 options. By simply checking a box on the form, the standard deduction and the tax brackets will be split evenly between the 2 jobs. The issue here is the assumption that their 2 jobs provide equal income is what makes this the least accurate option, because it's just splitting that deduction in half and splitting the brackets, which, in most cases, having equal income will likely not be the case. So now that we know, what the options are, next we'll talk a little bit about when the employee should make changes to their W-4. So in addition to updating their W-4 when the new form is released, or now that the new form is released, there are certain life events that should lead an employee to consider updating their W-4. For instance, this could be obtaining a second job or a spouse starting a new job, could be realizing a large investment gain. All of these are reasons they may want to increase the amount of tax withholding that they have due to these changes in income. On the other hand, getting married, having a child, these could potentially be reasons for decreasing withholding. So that's another good opportunity to revisit their W-4. Or they could be in a situation where maybe they incur a large medical expense, they purchase a home, they make a donation to charity. These are events that may allow someone to switch from taking the standard deduction to itemizing. Or it could simply increase the amount of deductions they are already itemizing if they were doing so beforehand. So it's always going to be a good idea for employees to be revisiting the W-4, not only when the new form comes out, but throughout their time of employment. So when these changes occur, it'll be important for employees to know what resources they're going to have available to them. So the W-4 process in general has typically provided employees with a lot of uncertainty in the past, and was something that they may have avoided revisiting even when they had life changes. Now that these changes are occurring, there'll likely be many questions from employees on the new W-4. So it's going to be important to consider how these questions will be addressed and whether additional support will be needed to help employees navigate through this transition that they're going through. In the meantime, the IRS has made several resources available to learn more about this topic. Originally I was going to say that the draft version of the W-4 is available, but as Debbie and others mentioned, the final version has been released today and can now be viewed on the IRS website. There were some minor changes, but most of the W-4 is substantially the same as it was to the draft.
Hey, Tom?
There's also that, yes.
I'm sorry to interrupt. This is Debbie, but we just got a really great question that came in. And it is, there's a lot of employees, they don't want to show their private financial information on the W-4, so they can get additional withholding. What is their option if they don't want to share that private information on the W-4?
Right. So, as we were talking about earlier, if they don't want to share that information, using option 1 of the form, or where they're using the tax withholding estimator, is not going to provide any of that information to their employer. So that would be the option that would allow for them to protect their privacy, essentially, if they weren't wanting to disclose that information.
Right, or they could just, calculate what they need and just ask for additional withholding and leave it at that, right?
Sure, absolutely. They could do that as well.
Thank you.
Yep. So again, the resources are there to help them from the IRS. And that those, for the time being, will be where they could go if they're looking for additional information. You could click on any of the hyperlinks there to be taken to each one of those resources. But again, it'll be important, over the coming months to really look to see if they're going to have the support or the resources they need as they navigate through these changes that they're going to be faced with the W-4.
And Tom, another thing is I'm getting a lot of comments about employers being very concerned about getting too deep into helping employees with their W-4 questions because they don't want to be giving tax advice.
Sure. Are
you seeing that kind of concern out there with the clients you're working with, and how are they addressing that? We
are. So, as you said, typically, employers really aren't comfortable having detailed conversations about the W-4 or tax issues in general, which is understandable. Most of the conversations that they're having are focused on, that the employee has to file the form, but, it's up to the employee to really determine what changes they need to make. What we see a lot of clients doing, and what we've seen through a number of our financial wellness programs, is providing a resource for them to go to for questions like this. And, updating the W-4 is a popular topic that we speak to many employees about through our financial wellness programs. So, using third parties to get a lot of these issues addressed is something that we're seeing a number of clients do. And particularly they're providing services that range from call center support, as you mentioned, to group seminars, to digital resources, but we are seeing a lot of folks address it through financial wellness programs that they might be offering. All right, and with that, Christy, I think we have the results from our last polling question, or do you have those results?
I do, and it looks like most of the audience is somewhat confident that their employer will meet the new Form W-4 and income tax withholding requirements for 2020. And we also have our next polling question. So while folks are responding to our next polling question, I'm going to ask you, Debbie, a couple of questions here that have come in that I think we need to address. Does the 2020 Form W-4 affect only new hires? And then also, if an employee does not intend to change their withholding to the new Form W-4 in 2020, will there be a point in future tax years where they will be required to complete a whole new Form W-4? Debbie or Tom?
Good question. So who has to complete the 2020 Form W-4? Only your new hires and only those employees that need to make a change to the W-4. And that does include anybody who claimed exemption from withholding. Another question we're getting, does the February 15th deadline still apply for an employee who claimed exempt? Yes, it does. So if they claimed exempt in 2019, by February 15th, they have to give you a 2020 Form W-4. So who does this affect? New hires, employees who claimed exempt, and anybody who wants to change their W-4 after January 1 of 2020. Will the IRS at some point require that all employees complete this new form? That's doubtful. Here's why. Remember, these are temporary tax provisions. They suspend or expire after 2025. So we may be going back to the old W-4. I don't see the IRS requiring that all employees complete the form. So that would be my answer to that.
Thank you. So with that, Nico, I think we are ready to hear about state-paid Family and Medical Leave Act insurance.
Thank you, Christy. So paid family medical leave insurance has seen some significant momentum over the last few years in terms of legislative enactment at the state level, as well as on the employer side. We're seeing employers adapting to the changing needs of their workforces by implementing and expanding their existing paid leave programs. The map on this slide shows which states currently have a state fund and what year they enacted their programs. You'll notice that some of the states have an asterisk. Now, these are the states that have enacted programs that are effective for year 2019 or later years. And you can see that there's 5 of them out of a total of 9 states that have enacted programs in total. So the majority here, these green states. As you can see on the slide, we definitely have a trend. In 2004, California was the first state to adopt a paid family and medical leave program. Now, California is kind of interesting. Their PFML program is part of their state disability insurance program. So there isn't a separate tax for paid family medical leave per se in California. Rhode Island was another early adopter in 2014. But you can see all the rest of these enactments from the states have happened after that. So we're definitely seeing a trend. It's mostly in the progressive states, as you can see, and it's mostly over the last few years. Now, what about Colorado? If you notice on the map here, it's colored yellow rather than green. So earlier this year, Colorado nearly passed a bill that would have created a state fund for paid family and medical leave that would have been funded by both workers and employers. Now, that provision in that bill, SB 188, or the family bill they called it, was amended at the very last minute to instead become a study. And as part of that, the law established a task force to explore feasibility. And this makes sense, and frankly is very likely to be an issue for other state adopters in the future as well, because the only way to keep these trust funds solvent is to keep the contributions and payouts balanced. And from what we've seen to date with the existing programs, they can be extremely popular. But as a result of that popularity, they can come at a tremendous cost, which translates to increased contributions. So at some point, if the contributions get too high, there may very well be pushback and resistance to implementing these kinds of programs. And a case in point from recent history is actually New Jersey, for example. So earlier this year, New Jersey enacted some legislation which is effective starting January 1st of next year, so 2020. And the law basically does a few things. It separates the computation of New Jersey's temporary disability insurance, TDI, and their family leave insurance, FLI taxable wage base, from that of the SUI taxable wage base. And then secondly, it increases the FLI wage base by almost 4 times its current level. So the 2020 FLI taxable wage base is increased to a whopping $134,900. It was $34,400. So, that's a drastic increase. But it was clearly necessary for New Jersey in order to retain the solvency of their paid family medical leave fund. So it's an interesting question, in other words, whether these programs will be able to survive in the long term in light of the potential for these astronomical contribution requirements in order to retain fund solvency. So moving on, a paid family leave overview. As mentioned earlier, paid family and medical leave generally follows the state unemployment insurance law for purposes of determining what's constitutes covered employment and what constitutes taxable wages. One of the frequent questions we get on this is around multi-state employment. So let's say we've got an employee that's working out in one state but living in another. To which state do we allocate for paid family medical leave purposes? So you'll generally follow the state unemployment rules for sourcing, which means you would not be paying PFML to more than one state. You'd be using the four-pronged test for unemployment, and you would only source to a single state based on localization, base of operations, place of direction or control. If none of that works, or if the facts aren't clear, the employee's residence. Now, from a taxable wage definition standpoint, the same is true. So the general rule is the same, that the definition of taxable wages for PFML contribution purposes will follow the definition of state unemployment taxable wages for that state. The only exception, or it's more of a nuance here, is that the SUI wage limit may be different. So it's the same with New Jersey, right, starting in 2020. So states are tending to follow that trend because the expectation is that their paid family leave funds will pay out more benefits than their SUI fund will. So you'll find the PFML wage limit to be higher than the SUI limit generally. In fact, in most of the states that are adopting these programs, they are using the Social Security wage base as the wage limit for paid family medical leave purposes. Now, generally speaking, paid family medical leave is administered by the state's unemployment insurance agency. There's a few exceptions, like New York, they administer theirs out of the Workers' Comp Board. Massachusetts is another one. They administer theirs out of the Department of Revenue. Moving to the left side of the slide here, most states allow employers to self-insure or to use a third-party insurance provider for paid family medical leave in lieu of using the state fund. Now, this is facts and circumstances driven, obviously, but I'll tell you, we generally recommend caution to our clients that decide to use a private fund for paid family and medical leave. And the reason is simply because paid family medical leave is fully taxable. And we frequently find compliance gaps with third-party providers not being fully compliant with the tax withholding and reporting requirements. So, though not always the case, we generally advise against utilization of a private fund for PFML. So what about taxability? Next slide here. On this slide, we're comparing leave and disability benefit payments and their taxability. In both cases, the taxability is going to be driven by the type of plan being used. So in other words, whether it's private or state-funded. For disability, if it's a state disability benefit paid under a state plan, the disability is taxable wages to the extent that the employer paid the premium. Now, in most states, the premium is employee paid. And if that's the case, then there's no taxable amount. So, for example, with California, and I think Rhode Island as well, the employee pays 100% of the contribution. Therefore, disability paid out of California is not taxable. If you look in New Jersey, though, they're different. Disability contributions are partially paid by employees and then partially paid by employers in New Jersey. So in that instance, to the extent that there's an employer contribution, a portion of the benefit payment will be considered taxable wages. And to compute the taxable W-2 reportable wage amount in that instance, you would take the total contribution and compute the percent of that contribution that's paid by the employer, and that portion or percentage of the disability benefit payment would be considered taxable. And this is the reason, of course, that New Jersey gives a statement to employers, because just like with private insurance arrangements or third-party payers, employers have a co-reporting obligation. And the co-reporting, I mean, that also includes the payment of FICA as well. In terms of trends, most of the states follow the lead of California and Rhode Island, where there's no employer contribution, which, as we discussed, results in the benefit not constituting taxable wages. One last thing to mention on state disability, just because it comes up once in a while in discussions, state disability does not get reported on a 1099-G, and the reason is that the Internal Revenue Code provides that disability pay is a wage. So to the extent that an employer is paying for the cost of the insurance, then it becomes a taxable wage and is therefore W-2 reportable, not 1099-G reportable. So that's disability. What about paid family and medical leave? So collectively, paid family and medical leave benefits can be paid through either a state fund, a private insurance company, or an employer's plan or policy. If the benefits are paid by the state through a state fund, the benefits are reported on a Form 1099-G because there's IRS guidance out there from the time of the early adopter states supporting the idea that paid family medical leave is paid in the nature of unemployment insurance, and unemployment insurance benefits are reported on a 1099-G. Therefore, the PFML also is reported on a 1099-G. On the other hand, when benefits are paid by a private insurance provider or an employer's self-insured fund, the full amount is treated as taxable wages reported on a W-2. Similarly, if there's no state plan, but rather the state simply mandates that you pay the employee's paid family medical leave, so for example, you have those states that say you need to give the employee up to X number of hours of paid leave for either their own illness or that of a family member, well, in that case, all of that is regular taxable wages because, one, it's not getting paid out of a state plan, and two, it's not defined as disability, so it can't be excluded on that basis. Disability, and one question that comes up or issue that comes up is the comparison between disability and paid family medical leave. They're two different things, obviously, and it's often a point of confusion, and that's why they're taxed differently. So disability is providing a benefit for the employee's own illness, whereas paid family medical leave provides benefits for illnesses other than the employee's own illness. What if an employer decides they want their private insurance company to pay out benefits instead of the state fund? Well, under this approach, the third-party provider would have to agree, essentially, to withhold all the federal income tax based on the employee's W-4 elections. Keep in mind that, unlike with disability, this is not an optional W-4S type of election here with paid family medical leave. The withholding is required, and FICA withholding is also required, as are W-2 filings, etc. So we often get the question of, well, can we just report these payments on a 1099 because our third-party provider is telling us that that's what they want to do? Well, technical answer is no. These are W-2 reportable, and the employer as well as the third party can be held jointly and severally liable for the underreported amounts and any penalties.
Hey, Nico, I have a question that came in. Have you seen any legislation on how bordering states, both with paid family medical leave programs, will address the effect on employees who live in one state but work in another? For example, I guess if an employee lives in, let's say, Connecticut but works in Massachusetts, is that individual going to be hit twice?
Yeah, thanks, Christy. That comes up all the time, and again, we follow the state unemployment insurance rules for purposes of sourcing for PFML, and so you're going to look at either the localization, base of operations, place of direction or control, or if none of that is clear, the place of residence for purposes of sourcing. You'll only want to source to one state. I think what's lacking, frankly, a lot is or significantly, and is an issue for implementing some of the state rules, is federal legislation defining what it means, and we'll talk about this shortly on the next slide here, what it means to require that the employee pay the tax. And it comes up in, where the employer is paying the employee portion. But to your question, yeah, there's really not that kind of legislation or guidance out there because we follow the SUI rules.
Okay. Wonderful. Thank you.
Sure. Moving on to the next slide about taxability. So what about taxability of PFML employee contributions paid by the employer? So the issue has come up here that I just talked a little bit about it. What if the employer pays the employee's PFML contribution? Now, we all know the general rule is that if an employer pays any tax that an employee is required to pay, and by the way, that includes federal, state, or local taxes, that contribution or payment made by the employer becomes taxable wages. That's the general rule under Regulation 313401. So we need to first figure out, is the tax required to be paid by the employee? Is the legal obligation to pay the tax the employee's obligation, or is it the employer's legal obligation? And for PFML purposes, that's going to be dependent on state law. And state law, unfortunately, is not always very clear. And as the slide indicates here, Massachusetts is a good example of that. The Massachusetts rule is that if there's 25 or less employees in Massachusetts, the employee pays the PFML contribution, and the employer need not pay anything. But the rule also says that if there's more than 25 employees, the employer may deduct the contribution from employee wages. So it's a question of whether we can argue that the employee is not obligated to pay that tax. And frankly, without IRS guidance, it's really not that clear based on the Massachusetts state law that we just talked about. So our perspective, just in practice, and again, this would be dependent upon the facts and circumstances, of course, in each case, but our perspective has generally been that if the state law is ambiguous about whether the employee contribution is mandatory, we would likely advise taking the more conservative position that the PFML employee contribution that is paid by the employer be treated as taxable wages to the employee, just like any other tax that's paid by an employer for an employee. So with that, Christy, I see another polling question and believe we have results from the last polling question as well.
We do, Nico. So we do have another polling question coming up. And hopefully you guys are starting to notice a theme to our polling questions today throughout our webcast. But we do have the results from the last one, and it looks like almost 50% are going to be issuing an explanatory letter to deploy to assist their employees in understanding the 2020 Form W-4, with 23% having an employee website for training and with training materials. And then a small number of you each with a live training, a call center, or none of the above, I guess, to be determined. So with that, please answer and respond to the polling question. And Pete Berard, can you give us some updates on other state and local developments? Excuse me.
All right, you can say that again. Thanks, Christy. Good to be with everybody today. I'm going to be, as Christy had mentioned, I'm going to be discussing a lot of state and local development, so there's a lot to cover in a pretty short amount of budgeted time, so let's buckle up and move along. On the slide we have here, we have a map of the U.S. which shows all of the 2019 state unemployment wage bases for this current year. Now, as you'll notice, we have them color-coded based upon kind of the bucket that they fall in terms of the dollar amounts for that wage base. So the dark gray are the tax jurisdictions that have $7,000, the federal minimum. Your Puerto Rico, California, Arizona, and Florida. Your light gray is the next bucket, which goes up to $18,100. Your light yellow is the next bucket, and your dark yellow is the bucket that has the states with the highest amount of taxable wages in their wage base. And one thing to notice is that for the states that do have the turquoise dot, you need to be mindful that those states will adjust their wage base annually. Moving on, how does your state's rate in terms of tax rates and jobless rates, and as you can see, in terms of 2019, or at least for a period into fiscal 2019, from May of 2018 into May of this year, that the national jobless rate has dropped 0.2% overall. And as you can see on the left-hand part of the chart, we have the 10 lowest in terms of jobless rates. All of them have rates that are decreasing, from the prior year, with the exception of Hawaii, which did go up. which is kind of interesting. Also on the right, we have the states that have the highest, 10 jobless rates, and that's kind of a mishmash of some states that are decreasing, some states that are increasing. So interesting facts there. In terms of the FUTA credit reduction for our next topic, this is something that I was actually just asked about at a client meeting just the other day. So it's good to report that the FUTA credit reduction for 2019 only applies to one jurisdiction. Unfortunately for employers in that particular jurisdiction, it is the Virgin Islands. So it's projected that the net FUTA rate for 2019 will be 3.3%, which means an additional $189 per employee in excess of the standard, $42 per employee. So as we have noted here, the benefit cost rate, which we received as courtesy of the U.S. Department of Labor, the additional 2.7% add-on could, in some cases, apply. It could be waived. However, the USDOL has indicated that that will not be the case for the Virgin Islands in 2019. So it is definitely projected that that net FUTA rate will be 3.3 per employee for this year. In terms of overall trends on our next slide, we show a chart here which certainly has a lot going on. We're trying to show you a lot of information in one particular spot. So we're trying to show you the increases in jobless rates, increases or decreases in your SUI wage bases, and increases and decreases in your tax rates. We also have a chart underneath showing the numerical figures for each of those years from 2013 to 2019. Now, a few observations to be mindful of is that there were fewer jurisdictions that increased their base tax rates in 2019 than in any year other than 2013. And in 2013, we saw that the largest number of jurisdictions with base tax rate increases, whereas in 2016, we saw that the largest number of jurisdictions with base tax rate decreases. And in 2018, we saw the largest amount of jurisdictions with a SUI wage base decrease. So all interesting facts. More about the FUTA credit reduction. As you can see from that same period, actually with one more year from 2012 to 2019, that the number of jurisdictions that are subject to the FUTA credit reduction went from a maximum of 19 in the 2012 tax year down to just the one for the U.S. Virgin Islands this year. Okay. Now, going into the state and local developments, as some of you are probably aware that earlier this year in September, the California Senate passed some legislation known as AB 5, which codifies the decision of the California Supreme Court in the Dynamex case, and that's the ABC test, and it expands and clarifies its application. So for those of you who might not be familiar with the ABC test, that means A, that there's an absence of control by the employer on the worker. The B part of that test is that the business is outside of the company's usual course of business. And C, the position is something that's customarily that of an independent contractor. So I just want to fill you folks in on that if you weren't familiar. But essentially, the bill would significantly impact all industries that customarily engage independent contractors. However, it's widely believed that the greatest impact will be upon folks in the gig economy, so your rideshare companies and your delivery drivers, that they'll be the ones most widely affected by this particular issue. In Connecticut, and this is something that I've certainly been talking to a lot of clients about recently, their telecommuter rule, that based upon some legislation that was passed late last year and effective as of the 1st of this year, Connecticut income tax is imposed on non-residents who perform their services outside of Connecticut for the convenience of the employee. And that this new telecommuter rule applies only when a non-resident employee is a resident of a state that imposes a similar rule or a mirror rule in the state where the employee is working. So the states that have mirror rules are New York, Pennsylvania, Delaware, and Nebraska. So it seems like it's fairly limited application outside of New York generally, but it's definitely a new law that is intended to have reciprocal treatment similar to New York's telecommuter law. That there were a number of Connecticut residents that were reporting to New York companies as a telecommuter, and Connecticut was not permitting them to have resident tax credits for taxes paid to New York. So as a result of this law, that tax credit will be reinstated for those folks that are working or as telecommuters in Connecticut reporting to employers in one of these 4 states. So that the telecommuter rule really does create that reciprocal treatment. So that's something that Connecticut taxpayers are quite happy about. Moving on to Jersey City, New Jersey, that in late last year, which I believe we had talked about on our webcast last year at the end of the year, that the City Council had unanimously approved the establishment of a 1% payroll tax for employers, and it was Ordinance 18-133. More information can be found on the website if you're not familiar, and we have a link in there that you can click on. But essentially, this tax was paid by employers and is not withheld from the wages of its particular employees. All private for-profit employers located within Jersey City that have quarterly gross payroll of $2,500 or more are subject to the tax on the wages of non-Jersey City residents. So that is something important to remember, that Jersey City residents are exempted from this particular tax. Keeping in New Jersey, there was some New Jersey legislation early this year, Senate Bill 1567, which requires employees of 20 or more to offer pre-tax transportation and fringe benefits to employees as of the earlier of March 1st, 2020, or the effective date of regulations that are imposed by the New Jersey Department of Labor. So one thing that is interesting about that is that further clarification will definitely be necessary, because New Jersey currently, their tax law does not offer any type of tax benefit for pre-tax transit benefits, that are paid through a salary reduction program. So that's something that's to be mindful of and to watch going to the future. New York City, there was legislation that was introduced to impose a New York City payroll tax paid by the city's employers for the funding of expanded child care services. This is coming out under the New York City Comptroller's NYC Under 3 program that lays out the reasoning for implementing a plan for affordable child care for New York City families. So this has been introduced, but it has not yet been passed. The payroll tax, again, is employer paid, would not be deducted from employers' wages, and is based on graduated rates, which are a result of the quarterly payroll expense of the employer. And those are laid out below. So tax rates of 0.15%, 0.18%, and 0.22%. All right, moving on to Philadelphia. Just a few days ago, and I know Debbie had put out a nice big alert on this, that the mayor signed into law a new ordinance that's considered to be a landmark as far as domestic workers goes, that it provides them with a legal right to portable paid time off that will become effective as of May 1st of 2020. So it is, with the exception of casual work, which is yet to be defined by the city, each employer of a domestic worker will be required to pay a pro rata share of paid leave funds into a portable leave system that's based on the hours worked for the employer. This program is consistent with the Philadelphia Paid Leave Ordinance, and such that the employees will get 1 hour accrued per 40 hours worked for a maximum of 40 hours per year. The ordinance is silent concerning how payroll taxes will be withheld and paid, and how reporting will be required for these particular payments. So we need to be mindful of that and just watch out for that those events coming up soon. But there is widespread speculation, say that 10 times fast, that the Portable Benefits Program will be a model potentially for cities and states across the U.S. for all gig workers. So something, again, to be mindful of. A few other items on the docket here for Washington, that there was some legislation early this year that beginning in 2022 through December 31st of 2023, employers will be required to withhold and remit premiums equal to 0.8% of employee wages to fund the state's long-term care insurance program. And effective January 1st, 2024, the department will determine the rate biannually, but no greater than 0.5%. Also, Montgomery, West Virginia, earlier this year in July, there was the city of Montgomery that put into place a new city service fee, much like a lot of other jurisdictions in West Virginia, such as Charleston and Huntington. But the thing to keep in mind here is that this is demonstrating a trend of new local taxes across the country, and these are very easy to overlook. So you need to be mindful of all of these updates that are happening. All right, so moving along, the mobile workforce income tax. This is one of my favorite topics because it's been introduced a number of times since 2009, but while it has passed the House a few times, it has not been able to get through in the Senate. And it is currently opposed in the Senate, as it has been since 2012 and 2015 when it will reach the Senate on bills at that time. So currently there are definitely some more pressing matters in the chambers of Congress. All right, last slide here. Just some payroll tax matters that we would definitely recommend that employers take. They're all interlinked, so that you can get as close to being compliant as you can. That's definitely the goal. You want to be compliant with your federal, state, and local laws. But it's just some good recommendations in terms of providing folks with statements that break down the wages that they actually earn in each state, or maybe even put that in box 14 of the W-2. Provide employees with an annual relocation expense statement, so that can be used in the states that do still continue to allow the moving expense deductions, such as New York. You want to give employees ample notice of changes in withholding rules, whether it be as a notice on their pay stub or in a separate mailing. You want to monitor the regulatory and statutory payroll and benefits changes. You might want to consider geocoding for your employees so that you can make sure that you're adhering to the applicable local, federal, and state tax obligations based on their work location and their residence. You want to consider an earnings and deductions code review to make sure, again, that you're subjecting the applicable types of compensation to the applicable taxes for your employees. And you might also want to take a look at an electronic W-4 system to make sure that you're using the latest state and local withholding allowance certificates. So, Christy, back to you.
Thanks, Pete. I think in the essence of time, we are going to move on to Nico, where he can tell us a little bit more about taxability.
Thanks, Christy. So we're going to speed down the road of taxability here in light of our time constraints, pardon the pun. And specifically here on this slide, the question of what can go wrong with earning and deduction codes. Well, for one, they can be improperly named. So this is the first flag here, titled labeling, and this can cause an incorrect tax setup. So for example, a deduction for a health savings account, an HSA, may be improperly labeled as a health FSA. The annual limits in the federal and state tax treatment are different for these two benefits. So this is one big issue we encounter when we review clients' earnings. If they haven't labeled them correctly, so all the taxation as a result and the withholding and the reporting is incorrect. Reporting, which is the second flag on the road, so depending on the nature of the benefit plan, for example, stock or life insurance benefits, special W-2 reporting may be required. So this is another area where we regularly find errors, usually with boxes 10 through 14 on the Form W-2. And then tax setup, the third flag on the road. The question here is, are the proper attributes for FICA, FUTA, SUI, FIT withholding, SIT withholding, LIT withholding, properly configured in your system? Also, is the item properly classified as a supplemental wage? So the tax setup, can vary based on the tax type and the jurisdiction, and with a large employer with a large state or local footprint, there are many things that can go wrong. So what are the risks if a tax setup is wrong? On this next slide, well, underpayments, underwithholding, accuracy-related information reporting penalties at the federal and state levels. In most states, there's officer personal liability for underwithholding and inaccurate reporting. Litigation is another risk. Some tax and reporting errors particularly those that involve non-qualified plans, can lead to costly employee litigation. And we reference here on the slide the Davidson versus Henkel case, where the employer didn't properly execute the special FICA timing rule and wound up being held liable for the increase and taxes that were a result of that. And finally, reputational risk. I mean, these kinds of errors impact employees' tax returns, loan approvals, all kinds of things. And they can lead to negative and unwanted publicity. So, myths and facts on this next slide here. Localities follow the state income tax definition of taxable wages. So this actually came up at a tax conference I spoke at recently, and it's wrong. That's a myth right there. It's not necessarily the case that localities follow the state income tax definition of taxable wages. And Kentucky locals are actually a great example here, in that each Kentucky local jurisdiction has their own unique definition of taxable wages, and there's no state law that requires conformity with the state definition of wages or any other definition of wages. So this is an area where we see lots of issues. Our team just finished up one of our taxability reviews on a big client out here, and that client's configuration was just, was erroneously conforming all local tax reporting and withholding configurations to the federal Medicare wage rules, which is wrong. There are some localities that follow that rule, but by no means all. So for example, in Ohio, you have two general categories of local employment taxes, one of which is tied to the definition of Medicare taxable wages, the municipal taxes, and the other, which is not. So the school district taxes, they follow they're tied to the federal taxable wage definition, or W-2 Box 1 wages. Other localities, like in Kentucky, which we just talked about, have their own definitions. So it's these types of nuances that can create significant risk if not addressed from a local taxability standpoint, if the settings are not properly configured for withholding and reporting purposes. The next slide, unemployment insurance taxability. This is another myth, that taxable wages for state unemployment insurance is the same as taxable wages for federal unemployment insurance. It's the exception and not the rule that states blanketly follow the federal definition of taxable wages. Most states have their own unique definition of taxable wages for SUI, and they don't necessarily follow federal. And some examples of that include things like severance, disability pay. Some states don't require SUI tax on contributions on any portion of disability pay, be it short or long term. And particularly this can come up, of course, with employees who don't work the entire year, or if they live in a state with a high SUI wage base, so they don't meet the wage base. And therefore the tax is not maxed out and is paid unnecessarily on exempt wages. And the last myths and facts slide, state income taxability, that the definition of taxable wages is the same for federal and state income tax. This is wrong. This is a myth. Some states do not conform to the Internal Revenue Code, and others need to pass legislation periodically in order to conform to the code. So the bottom line is that the best practice is to conduct an annual review of state laws to confirm taxability. It's absolutely essential as part of the annual, if not more frequent, payroll tax process and checklist. And finally, our last slide that covers some triggers to consider. So essentially, where any of the items in the life cycle circle that you see here exist, you'll want to consider conducting a taxability or earning and deduction code health check. And our recommendation is always that it's a prudent practice to conduct an earning and deduction health check as part of the annual year-end process. So with that, Christy, I see we have the results from the last polling question, and we're approaching our time.
So thank you, Nico. In light of our time, I'm going to pass it to Debbie and ask you, Debbie, for a 1-minute recap, please, before we end out today.
Sure. Thanks a lot, Christy. And I do want to remind everybody, polling question number 6, if you are a CPP or an FPC, Certified Payroll Professional, be sure to answer yes to polling question number 6. Otherwise, please answer no. And that's how the payroll folks will get their RCH credits. And we're coming at the end now. I do want to call everybody to go to the green icon. You'll see a number of PDF files there. One of them is our payroll year-end checklist. It is very detailed about all of the things that need to be done. There's also some other PDFs there on our fringe benefits reporting FAQ and our all-new fringe benefits reporting chart. So I do want to call your attention to that. And also, if you download the PDF file for the webcast slides today, all of the hyperlinks are clickable. And I bring your attention to the resource section where you'll find a number of our other special reports that you may find useful in year-end and some IRS forms and publications that also might be helpful. And with that, Christy, I'm going to give it to you for some closing notes.
Thanks, Debbie. On behalf of all our panelists today, I'd like to thank you, our audience, for joining us. The archive of today's program will be posted on the Thought Center webcast homepage in about a week, and this is where you can view many of our other webcasts as well. And if you've been with us for at least 50 minutes, responded to the polling questions, and if you're able to complete the feedback, you can now download your education certificate by clicking on the CPE icon at the bottom of the screen. For CPPs and FPCs needing RCH credit, we will email you your certificate, provided you answered the required polling questions. We definitely pay attention to your feedback, so before you head off, please take a moment, open the red feedback icon at the bottom, and let us know what you thought of today's program. Thanks again for listening, and season's greetings.